In this video, we're going to address really two questions. One is for people who say, well, you know what, IBC sounds great, but I just pay cash for everything. Or for individuals who say, you know what, I don't need life insurance. What we're going to talk about is what we always say at Infinite Wealth, that we do the math. So that's what we are about to do. So to begin with, we need to have a baseline. So what we're going to do is let's say that let's do this over 20 years. And let's say that you're putting $20,000 a year. The actual deposit or the dollar amount really doesn't matter. But what we want to talk about is our marginal improvement in each scenario. If you were to let's say you were to put $20,000 a year into some sort of account that you're going to use to finance things, what do you think would be a good rate of return that you would expect that a bank would pay you? Let's be conservative and say that you're going to earn 2%. Okay? On that 2%, that is also taxable. Let's just say you're in the 25% tax bracket here. Okay? So our baseline is if you were to save $20,000 a year at 2% in the 25% tax bracket, we'd have a baseline of 462. So let's see. Savings is going to be 462,473. Okay. Now, let's say that you're going to pay for a down payment on a home. Okay, let's say that down payment, let's say is going to be $60,000. Okay. And what you're going to do, you are just going to withdraw that out of your account. And let's do that in year 4. Okay. What we did is we just took out $60,000 in this situation for a down payment on a house. Now, what simple math might say, well, if we started with 462 and then we subtract out $60,000, simple math would think that we would be $60,000 less, but we're not. We're more. We actually only have $385 in our account. So here's a question. Why do we not have 402, but instead we have 385? The difference is that $60,000, since we withdrew it from our account, we broke the compound interest curve, and so this is what we call the lost opportunity cost. The difference here is what that $60,000 would have earned over this time period. And in essence, let's just see what that opportunity cost is. 385 192. Okay, you lost the opportunity to earn $17,000. Thus, that down payment didn't cost you $60,000. It actually cost you $77,000. Now, let's say that maybe you've read Nelson's book, or you've come to the realization, well, if I borrow money from a bank, I'm going to pay them interest, and my money's more valuable than theirs, so I'm going to at least charge myself the same amount of interest I would at a bank. So let's do this. What we're going to do is we are going to pay ourselves back. Let's just use 5%. And let's say we do it over 10 years. And okay. So what we've done is we've taken out $60,000. Let's see here. Then we are charging ourselves 5%, so we have that extra money, and that is going back into our bank account. So with the payback, we have 477, 490. Okay. Are we better off than just using the savings account? Obviously, we are, because we are putting money into it. We are being good stewards of our money, and we're charging interest for the capital that we use, the same as we would if we used somebody else's capital. Okay, so now how does this relate to the infinite banking concept? Well, there's going to be a few things here. One, let me ask you this. When you take $60,000 out of a bank account, how much is the bank crediting you in interest if you withdraw $60,000? It's zero. You do not have the money in the account, so they're not going to credit you interest, but also they're not going to charge you interest. When we do this, when we use the infinite banking concept, it's going to be slightly different. Because remember, we're not borrowing from our policy. We're not taking it out of our account. What we're doing is we're borrowing from the insurance company. Our money is still there, so they are going to continue to pay you interest, and in return, they're also going to charge you interest. So you earn it and you charge it. So let's see what this would relate to. What we're going to do is we're going to use a policy loan, and that's at 5%. What I'm going to do here, I'm going to load in the annual rate of return on an actual policy. Okay, somewhere. Oh, there we go. Okay. Look, as you're going to see, it's like we're starting a business. We're going to be a little bit behind at the beginning of the race, and this is what I'm always up front with this. If you're focused on short-term results, then IBC is not for you. If you're focused on long-term results, this can be an amazing strategy to help you achieve your goals. So what we're going to do here, instead of taking the money out of our account, what we're going to do is we're going to take an account loan. Now, so what we've done is we've taken a loan against our account. We've paid interest, but we've also earned interest. Well, so we're paying the same interest that we were paying to ourselves with the payback. See, I always tell people I went to school for accounting, not English, so I misspelled that. I'm trying to do two things at once, which is not easy for me. Okay, but now how much money do we have now? We have, with IBC, we have 535, 156. Okay, that's quite a bit more money. Just in the savings account, we had 462, but now even just with the payback, we have about $70,000 more. Now, why is that? It's actually going to be two reasons why it is different than using a typical bank account. For one, and probably the most important one, is that we never broke the compound interest curve. The value inside your policy continued to grow. In addition, a policy is going to earn at a much higher rate than a bank account. Also, it's tax-free. Oh, you know what? It appears I did not take the tax bracket off, so let me do that. Okay, all right. That's going to look even better. It wasn't 535, it's 590, 902. Now, so here's a question. With the payback or with IBC, did we change your cash flow at all? Nope. It's the exact same dollars going in, exact same dollars going out. Have you taken on any more risk? Nope. Are you working any harder? Nope. This is just the power of compounding and the power of using IBC. And in this situation, we just bought one thing for $60,000. For some of you, that's probably a car. What if your wife bought a car? Or what if you finance your kid's car? Or what if you use this to finance the down payment on a rental property? If we were to use this multiple times, what do you think that's going to happen with the numbers? With IBC, the more you use it, the more it grows. I hope this was helpful. This would be a good opportunity to learn more about this. Subscribe to our channel and check out our podcast, the Infinite Wealth Podcast. Go have an awesome day.